Good day, fellow investors. You are here for a value investing perspective on things. And that's exactly what we are going to start with today. The markets, why they are so high, which can be explained by the fragility on the economy, and how to navigate that so that you, for sure, reach your long-term wealth goals. Let's immediately start with the market. We are at all-time highs shown here, and all-time highs usually also mean extremely high valuations. If we look at the cyclically adjusted price-earnings ratio that takes into account 10 years of average earnings, then we can see that only once in history, during the dot-com bubble, at the peak of the dot-com bubble, have stocks been more expensive. All the other 150 years of history that we have, stocks have been cheaper than now. But given that stocks always go up, there is this expectation or situation that there is nothing that can stop the stock market and that you'll for sure make 10% per year. However, if we look again at the valuations, when stocks are cheap, you make more than 10%. When stocks are priced on average, this is what has historically led to 10%. But if we look at the normal P ratio, cancel this because this was weak earnings, then you again see how we are at very high valuation levels, comparing that to the dot-com bubble. What happened? Each time in the past when prices were that high for the stock market, 1929, late 1960s, dot-com bubble, well, what followed was a higher than 60% real stock market decline. The market is expensive. History tells us that a 60% real crash is ahead. However, there is something that is now perhaps more important than the expensiveness of the stock market, and that is worthless money. To explain that, we need to discuss the economy. And if we just show the best chart exposing what's going on, every government, developed countries in the world, and this is just US example, there is a deficit of, we can round it up to 2 trillion. And that is how governments work now. The net debt to GDP is just expected to grow, nothing wrong there. And that is based again on stable, never ever again a recession happening, full employment, everything great, low inflation assumptions. However, if you spend more than what you make, then that is, from a logic perspective, unsustainable. And that tipping point is coming closer because the borrowing keeps on going up. However, interest rates, the cost of that debt, what is the current issue, has been rising. If we look at the interest payments of the US government over the last 15 years, we have a 3x, from 353 billion to 1.1 trillion per year. If we go back here, that net interest payment is going higher and higher and will become the biggest chunk of total US government spending, which means it is fragile, unsustainable. The solution to this 2x in debt over the last 10 years, 2x to sustain the lifestyle, to be able to pay these higher and higher interest costs, the solution is always one, to solve the fragility of this economy. It's devaluing the purchasing power of money. $100 25 years ago is now in $25.50. So that is inflation, and this is government measured statistics. So usually you can add to real inflation, you can add 1-2 percentage points per year, which means that governments will take on more debt, more debt will be paid with money printing when there are issues. If this has been the situation over the last 25 years, I would assume that over the next 25 years, $100 now will not be 50, but likely 20 over the next 25 years. The 100 to 20 purchasing power decline justifies the expensiveness of this market. So that is the only explanation what, let's say, rationalizes this market. However, you are here for value investing, and value investing is risk and reward. If we look at the S&P 500, the current earnings yield, they spend most of the earnings on buybacks at these extreme prices, which is again shareholder value destruction. So I'm taking a 2% from the 3% earnings yield return plus inflation to 3% at best. At best, long term, you can get 5% from the S&P 500 at the moment. That's at best. Other possible scenarios include history repeating, like a 60% real percent crash. So on one hand, we have a real return of 2%, 5% nominal return versus the risk of a 50-60% real crash. Everyone invested in the market now is sitting on that. And then you can say, yes, Sven, but stocks go up 10% per year. No, stocks have been going up 10% or more per year. Over the last 30 years, stocks have given a 10x, have already done what you expect from the stock market. Thus, if it has been done mathematically, it doesn't mean it will happen again. Actually, the chances of that happening again are going down. So this is the key. Have been given, and now you have to be careful with that extrapolation bias, because what happened in the past doesn't mean it will happen again in the future. And the key difference is this: the P/E ratio was 7 here, was 15 here, and then stocks gave 10 or 40x, not from a P/E ratio of 30. Whenever stocks were high, you have the 60% decline following. What's the value investing solution? Well, can we reach that same expected 10, perhaps 15% per year returns with much less risk, without the risk of over the next decade losing 50-60% of real returns? How to do that? The key is fundamentals. If you go to my research platform, feel free to check it out, all my investment ideas. I've just started updating things by discussing everything in a 3-page summary. And then you can see here, for example, Amsterdam commodities just updated, discussing the business, the finances. And the key when it comes to this business, for example, is that the dividend yield is 5.88%. The P ratio is just 10. It's a food business, defensive business. And the key now is what will do better whatever happens. If everything continues like we are enjoying now, perhaps the stock market will do 10%. If everything continues, this company with a P ratio of 10 that is growing approximately 5, it did grow 8, and that's the target percent per year. So dividend yield 6%, plus growth, I'm again there, 10 to 15% investment returns. If this market crashes 60%, the dividend yield of the S&P 500 goes to 2.5%. If this crashes, the dividend yield goes to 12%, and then you again have a downside protection from whatever happens. That to me is value investing. And that is value investing based on fundamentals. So whatever the market does, the market has done 40 years bull market, whatever happens, I cannot predict, but I can focus on the fundamentals that are the driver of returns in good, where we try to match the 10-15% of the market. But we'll try to keep on doing 10 to 15% per year, even if the market crashes 60% over the next decade. Check my research platform down below and feel free to see whether this value investment strategy driven on fundamentals is something for you. When it comes to markets, this is a summary that I have placed on my free value investing for life course that you can join. And if you want to learn more on value investing, feel free to join. There you have a value investing perspective on markets, and this week I'll be updating the risk and reward value quadrant. This is the free YouTube version that will be updating. On my research platform there is the premium version. And there we'll be updating this situation view of the markets. What's the value investing perspective? And now the key is, how are you going to build your wealth over the long term? Are you a value investor? Which means not based on hope that stocks go up 10%, not based on hope or fear that governments will print, focused on real value investing, fundamental returns, because you want to do well no matter what happens. If you like that attitude, subscribe, check my research platform, and I'll see you in the next video.